I'm Rachel Carroll, President and Managing Partner at Edison. Smaller companies have been described on both sides of the Atlantic as the lifeblood of a nation, the engine for economic growth. And yet, smaller companies could be disproportionately impacted as the longer-term repercussions of the COVID-19 crisis catch up with the exuberance of the global stock markets. Today, I'm delighted to be speaking with Edison's Managing Director of Content, Neil Shah, on one of the most significant reports Edison has ever published. It has implications not just for the companies we work with, but also investors and governments around the world as we look ahead to future policy decisions. Neil, great to be speaking with you today.
Great to be here, Rachel.
Okay, so Neil, this is a fairly lengthy report for Edison, published in 8 chapters over a 4-week cycle. What is the main thesis of the report?
I think that the principal thesis of this report is that while small and mid-cap companies have performed particularly strongly in the first half of 2020, the full spectrum of risks aren't being priced in. This is something that I think boards need to be attuned to. There are so many unknowns as a result of COVID in terms of how we're going to emerge from it and what the economic shape of recovery is going to look like, and potentially, are there external shocks coming downstream? And I think that one of the concerns I have is that while a number of companies have come to market and raised capital, not enough of them have done so, and there's going to be a growing demand for capital in the next 6 to 12 months to 18 months. We've already heard the leading lights on the institutional side, people like Ann Richards, people like the CEO of Schroders, talking about the fact that institutions are there to support, but that they simply do not have enough bandwidth to do the entire range of support that's required. So the concern is that there's this pent-up demand that's going to be sort of coming to the market. Institutions have been active, but they're just not going to have enough to support that. And there is a potential capital chasm building in the market. It's not a certainty, but there is a real risk that's something that is downstream, and I think a lot of companies will need to think about what their strategies are in terms of accessing capital for the future.
So you're talking about a capital chasm, and yet the report also talks about the strong performance and ability to raise capital for smaller companies. So what evidence is there to really support these concerns?
I think the sort of risk-on move in terms of supporting these smaller companies is based on, they were really beaten up on the back of COVID sort of coming to the market, and people did put money to work as they felt that governments came in and stepped in to support the environment, and they've been rewarded richly, and that the performance has been great. That doesn't take away from what I pointed out, which is that there are, some significant uncertainties out there. Sources of capital are difficult to access right now. I think, since the financial crisis, bank lending has been much, much tighter. Private equity really did step into the gap that was created and, have really come to the fore over the last decade. But you've seen, private equity go reasonably quiet in Q2 2020. Everyone keeps referring to the fact that there is this, 1.4 trillion of dry powder out there. But I think there's a lot of private equity funds that are, looking at those existing holdings, thinking about what they need to do to repair those. So there is, to a certain extent, sort of some retrenchment that we're seeing in the private equity side. And, the last decade has seen public markets really fall out of vogue. So this long-term trend of a smaller number of IPOs each year has still been in place. Last year, we saw, I think, 50% less IPOs than we did, for, the decade previously. And that's in Europe and the US. Now, how quickly is that going to change? We don't know. I mean, evidence in the US market for the first half is encouraging. We've definitely not seen that in Europe. And that's something that I think is cause for concern for me.
And this is quite a bleak outlook in some respects. Is there any room for optimism?
The big difference that we saw this time compared to the previous financial crisis, it was really neatly summarized by one of the investors that we talked to, is that the animal spirits are there. And I think that a willingness to participate and support companies this time, rather than shut up shop and completely take risk off the table, is notable. So you've seen public markets really rise to the challenge in the first half of 2020 as companies came to market either looking for support of their balance sheet or indeed accessing public markets from an IPO perspective. So in Europe, you saw about 55 billion raised. London was particularly active, raising about 43% of that. For H1, I think that was 15% more than that was raised for the entire 2019 period. IPO activity has remained subdued in Europe, but by contrast, the US market has been very active. So the first half, 139 billion was raised in the market, which way outstrips the 109 billion that was raised for the entire 2019. And what we're hearing is that private companies which had been supported by private equity, by venture capital over the last decade or so, are now thinking that they want access to public market currency. And from ECM teams that we talk to, we're hearing that a lot of those IPOs that were positioned for post-election in the US, for Q1 2021, are actually having discussions about, bringing those forward into September, October. And, look at the August that we've had. Normally a very quiet August, really, really robust IPO activity that we've seen. So there is cause for optimism, and the public markets have have risen to the challenge. But I sort of come back to the point I made earlier, which is the institutions, the people who are running these institutions are flagging that they don't have enough bandwidth to do what they think is going to be required to get ourselves through this.
And at Edison, so we work both with private companies, but predominantly listed companies. So you are a smaller company, you're already public. How do you prepare both your management team and your board for this potential capital chasm?
So first thing I would say is that in the survey work that we've done with investors, there's still quite a lot of investors who are very active in the small and mid-cap space. And, don't be afraid of accessing public markets just because of size. There are a number of investors who want to get involved in that area because they see that there is a sort of leveraged recovery for the small and mid-cap companies, as we come out of this. What are they looking for? They need companies with sufficiently strong balance sheets to be able to weather the storm. So that is one of the very first things you need to have in place before you come to the market in terms of raising money or selling your story to investors, is that you've got to have thought through what your balance sheet is going to look like, on a post-money basis, pre-money basis. I also think that you need to have a story that is going to resonate with them, given the economic uncertainty, given COVID. So, how are you going to capitalize on the market right now? What opportunities as you as a business? Plus, I think you're going to have to address some of the sort of ESG concerns that are out there. So, how have you been looking after your employees? How have you been looking after your customers during this very difficult first 6 months of the year? I think the biggest mistake companies make is that they focus on too narrow a pool of capital. As we have worked in the US market, we're aware of just what a vast pool of money that is available. And the mistake would be that, you focus on, tier one institutions, which are important. They're also an area where, you're seeing increasingly concentrated sort of followings because of regulatory change amongst the sell side. A lot of the neglected capital is, money outside of the sort of main financial hubs, family offices, some of the smaller asset managers, private wealth management, and also retail. And retail has been really important this first 6 months in terms of supporting small and mid-cap liquidity and actually supporting small and mid-cap raises. So I think, think about accessing the broadest pool of capital, and also think very clearly about making sure that you've got the tick boxes in terms of what investors are looking for.
And on that note, the heart of this report was really speaking to the market, so speaking to those investors in both the UK and the US across that broad range of different investor classes, as you mentioned. I was really pleased to see that there were a lot of really thoughtful suggestions for policymakers within the report. So in your view, what should governments be doing?
I think the first thing is to be sensitive to the fact that, their actions have led to the capital markets working and flowing capital to companies. The immediate response, both on the fiscal and the monetary side that you saw, and the substantial response that you saw, really have lit up the market. And I think that the risk is that if that is withdrawn, too early, you're going to see a repeat of that taper tantrum. And so I think that that's probably the most important thing, is that governments continue to support the market, underpin the market, so that we can continue to sort of recapitalize the small and mid-cap companies. Are so important to the growth and the job growth that is going to be required going forwards. The second thing I think is thinking about how you actually can unlock some of the sort of pools of capital. And we refer to the term dark capital because there's a lot of money out there which people can't necessarily access. And it's a range of identifying that, but also unlocking it. And some of that is going to require some regulatory reforms. So some of the things we've heard talked about is, the CEO Schroeder's suggested the UK government creating a patient capital fund. What companies need right now is not more debt. They need equity. They need to rebuild their balance sheets with equity, and governments can be long-term partners for a lot of the small and mid-cap companies as they go through that. We've heard of some talk about some pension reform. So just because of the way demographics are right now, pension funds haven't been as active this time around compared to the previous financial crisis in terms of participating in IPOs. And that's just a reflection of the fact that, they are in de-risking mode. But you can change policy to make sure that a certain portion of their those funds are going into, patient capital, things that are going to support growth and innovation. I think tax incentives on the equity side. There's plenty of incentives for a company to raise debt. There's a growing chorus in terms of raising similar kind of incentives on the equity side is going to be important. And ultimately, I think some regulatory changes, such as the sort of MiFID II reform that you're hearing, unbundling, particularly in the small and mid-cap space, just to allow for more liquidity to flow to the smaller and mid-cap, companies make it easier for them to raise money using the existing infrastructure that's there. So there's, I think, quite a large set of reforms that I think can support us as we go through this. I'm just touching, the tip of the iceberg. I mean, there's a lot that could be done, and potentially we could come out of this in a much, much better place with a much, much better ecosystem for innovative companies.
Super interesting. Neil, Shah, thank you very much. If you'd like to access today's report or any of our investment content, it is all freely available on the Edison website. I'd also love to hear from you and your perspective on any of the topics that we've discussed today. Please email me at rachel.carroll@edisongroup.com. I look forward to hearing from you.